The September Canadian inflation data came in above expectations today. The latest inflation data is up 2.4% on a year-over-year basis. That's from the estimated 2.2%. So let's get more on this from Michael Davenport, senior economist at Oxford Economics. It's good to have you. Thanks for taking the time.
Good morning. Thanks for having me.
Let's just get your initial reaction first on the 2.4%, well above what was expected. What do you think?
Yeah, so it was an above expectations CPI inflation print for September. It was slightly higher than our forecast for 2.2%. And as you mentioned off the top, slightly higher than the consensus expectation as well. Now, the increase from August to September primarily reflected a few factors. The first one being a much less favorable base effect for energy prices. So last year, energy prices fell quite sharply in August and September. And so just this year, we're comparing to a much lower level of energy prices last year. Overall, if you look at the level of energy prices in the CPI basket compared to August, it actually only rose about 1% month over month in September, and we've already seen energy prices come down a little bit here in early October. The other two key factors that drove headline inflation higher in September were food prices. So food inflation rose about 4/10 from 3.4% in August to 3.8% in September. And we also saw rent inflation tick a little bit higher, as well as the volatile travel tours component, which has really bounced around quite a bit over the last several months. That also showed a much smaller year-over-year decline. And so those were some of the key factors that pushed inflation up in September compared to August.
Yeah, now this apparently lowers the likelihood that the Bank of Canada will cut interest rates next week. That's what some of the data is showing. But you still think the Bank of Canada will cut the interest rate by another 25 basis points. Correct me if I'm wrong. Why do you think that?
Exactly. Yeah, that's exactly correct. So while today's stronger than expected inflation print does certainly raise the odds that the Bank of Canada will step to the sidelines and pause, we do think that the Bank of Canada is still likely on track to cut rates 25 basis points at its meeting next week. So that really reflects the fact that underlying price pressures, despite the uptick in overall year-over-year headline inflation, underlying price pressures appear relatively well contained. So if we look at, say, measures of core inflation like the core CPI, so just CPI excluding food and energy, that actually held steady at 2.4% year-over-year. Now, some of the Bank of Canada's preferred core inflation measures remained in the 3% range, so right near the top end of their 1% to 3% target band. But if you look at some gauges of underlying core price pressures, they actually still appeared relatively benign, relatively contained. So the 3-month trend in the month-to-month core movement in prices, which is a really good sort of short-term gauge for where the year-over-year core inflation rate is moving, that remained below the Bank of Canada's 2% target, the 3-month moving average of that measure. And also, we've seen the breadth of inflation across products in the CPI basket tick down. So the share of consumer price index components that were rising above 3% actually edged lower in September compared to August, and the share that are rising at a pace of 1% year over year or less, so below the Bank of Canada's 1% to 3% target range, actually increased. And so overall, we think when you look and cut through the kind of volatility and the noise of the monthly data, what the Bank of Canada will continue to see is a trend of underlying inflation that is slowing, that is relatively contained. And ultimately, we think in the context of a weaker economy, an economy that's likely struggling to grow at this current juncture, and a labor market that's deteriorating, all of that will add up to the Bank of Canada cutting the policy rate by another 25 basis points next week.
Okay, so that was going to be my next question, right? You mentioned the labor market. We've seen employment weakening slightly as well. Like the Bank of Canada is going to be factoring all of that in.
Absolutely. So the most recent months, we did see a bit of an uptick in employment. But if you look at the underlying trend in the job market, it's clear that it is deteriorating. Employment has really only risen by about 20,000 since February 2025, when the trade war between Canada and the U.S. kicked off and the sort of near-term economic struggles for Canada really sort of began. And so overall, we think that the Bank of Canada is also taking that into consideration. We think the economy is really right on the edge of a potential recession through the middle of this year. GDP contracted sharply in the second quarter. It looks like GDP will be essentially flat in the third quarter, and there is a risk that it could contract for the second consecutive quarter. And so with the economy sort of really struggling to grow, likely to remain on the edge of a recession, and the labor market deteriorating, we think the Bank of Canada is going to look through this little bump in inflation at the headline level. Again, focus on those easing trends in core inflation and some of its underlying inflation measures, and ultimately opt to cut rates 25 basis points next week. Now, that being said, we do think that that will be the last cut for the Bank of Canada this cycle. We think they're going to hold rates steady from there.
Okay, just lastly, because I mean, you're giving us a good picture of the economy right now and some of the challenges facing Canada. Like, what is putting the most pressure on our economy? Is it the trade war, or are there other factors here, or is it mostly tariffs?
So that's a great question. I mean, so definitely the trade war and significant U.S. tariffs are probably the key factor that has led to the slowdown in the Canadian economy this year. And in addition to that, it's also this environment of uncertainty that's been created because of significant U.S. tariffs, because of the trade war. That's led firms to really put off, delay, or cancel investment plans, major capital expenditures. It's also led to increased job insecurity for households, which is causing them to pull back on major purchases, and also have some negative spillover effects for the housing market in terms of weaker household sentiment, kind of weighing on home sales, weighing on especially first-time buyers and investors who are looking at potentially investing in housing. And so that's also holding back the economy as well. Now, that's also happening in the context of some kind of high-level lingering imbalances that the Canadian economy already was sort of experiencing prior to the trade war, whether it be elevated household debt, persistently weak productivity growth, persistently weak business investment, and overvalued housing, particularly in the major metros like Toronto and Vancouver. And so while the trade war is the biggest factor in the near term, there are some other key factors that are sort of being influenced by the trade war, but also influencing the economy while the trade war is going on, and leading to this weak period of economic growth that we're currently in.
Okay, appreciate you joining us. It was good to get your insight. Thanks so much.
Thank you very much. My pleasure.
That's Michael Davenport, senior economist at Oxford Economics.